Thank you for hanging in there for our last panel of the day here, but it's going to be really fun and hopefully it'll be inspiring to you. So I'm Emily Chasan. I'm the Sustainable Finance Editor at Bloomberg, as my colleague just said. And I have a wonderful panel here. We've got Casey Clark from Rockefeller. We've got Christian from Impactive Capital. We've got Cecilia from Double Impact at Bain Capital, a special impact fund. And we've got Liqian from Cambridge Associates. And they are all over this space of sustainable finance. And we have a poll question. Can we go to the poll first? Because this space is growing so fast. I joined Bloomberg about 4 years ago, and it was not that big. But now there's like 31 trillion in assets in sustainable investing. And here's our poll question. How do you define your approach to ESG or impact investing? And we'll just let people go for a little. But let's start with Casey. How do you at Rockefeller define ESG and impact investing?
Very much believe that in order to help add to returns or reduce risk, that investors should be thinking about how environmental, social, and governance factors fit into portfolio construction.
Anybody else? Liqian, how do you do it?
We work with long-term institutions and families that are thinking about long-term value creation over the next few decades, not just over the next few years. And in that context, you have to think about what are the long-term systemic risks, whether it's climate change, inequality, poor governance. So ESG is critical to managing that risk. And on the flip side, what are the potential sources of value creation over the next few decades? And that's innovation, entrepreneurship. Impact investing can create avenues to capture that value.
Awesome. So let's look at the poll. Let's pause it for a second here because this is really interesting. I'm glad that most of you know what ESG is. But it seems like 48% say it's important to advocate for social or environmental issues, and that's behind your approach. It's interesting to see sort of the split on the other ones to see the impact. So I think our panel's going to shine a little light on this question. So let's start with Casey again. You have done some really interesting research on what the pipeline looks like in the private markets for this. Like I said, there were 31 trillion in assets on ESG. A lot of that is public market. A lot of it is bonds. But about 6 billion recently has been raised by like big private equity funds in the space. So I'm curious what this pipeline looks like because it used to be sort of small and it seems like it's getting a lot bigger quickly.
Yeah, it's growing rapidly. So when we think about private equity, we split up the field into 6 primary impact themes of climate change, sustainable agriculture, education, healthcare, financial inclusion, and affordable housing. And one of the interesting things that's kind of evolving is we used to think that diversity and inclusion was just integrated amongst all of those themes, and now we're seeing a subset of funds that are dedicated specifically to that field. So I think that'll be an increasingly growing theme. And our goal really is through outside managers to build portfolios that are diversified by themes, by geographies, and by vintage years across those strategies. And to your question about what are the most popular strategies now or what do we see in the pipeline, it's 3. It's really kind of multi-thematic strategies that span across all of those. Second is climate change, and third would be diversity and inclusion.
Great. And Cecilia, at Bain Double Impact, I think what you guys are doing there is so interesting. You're part of this wave of private equity firms that have just raised a ton of money, and big money, because there's actually only like 502 billion in impact investments. So this big money, big private equity coming in, and your approach. Can you explain, what you're doing?
I think part of it is the natural evolution of the impact space. Obviously, it started with a lot of impact investing in the venture space, and I think really the natural evolution is to, as companies graduate out of venture, to get into growth and middle market investments. And so we're really trying to focus on creating that next mission-driven, impact-oriented, source of capital, but also, expanding capabilities in that area as well.
So a follow-up question to that, because I think this is a really important point, because the venture capitalists have been saying, hey, I'm going to support you, I support your mission, and there hasn't been that next tier capital there to support the mission. So how do you think about scale? Because sometimes a company will get acquired by a strategic out of a VC, and maybe that works out, maybe it doesn't. But to grow a big mission company, how do you guys think about that at scale?
I think that's one of the areas where we try to think that we're very distinctive in terms of really leveraging our private equity playbooks that we've had decades of experience building on driving growth and scale. And so we have our strategic blueprint, we have our M&A and integration blueprints, we have our talent and our impact blueprints, and for really playbooks to drive that scale. A good example might be Health Drive that we acquired, which is a on-site physician services in a skilled nursing platform. We implemented both our double playbook, which was bringing two companies together, which was Health Drive, as well as NEG, which was New England Geriatrics, which provided additional services to that platform. But then we also leveraged our blueprint capabilities on driving strategy, as well as talent, and which is really important in these middle market sized companies because, for example, in these, we not only invested in creating a platform which was able to, bring technology, employee engagement, recruitment, compliance, which is important for these smaller healthcare companies, but then it also, allows us to bring tuck-in opportunities, which, for example, in this space is a lot of owner-operator or family-owned businesses, so they can come onto this platform, which really, I think, enhances the services and enables these companies to scale.
Taking a lot of small, impactful companies and putting them together and giving them that actual scale.
Exactly.
Right. That's really interesting. And so, Liqian, you guys at Cambridge Associates see across the whole market. How are you seeing this shift?
So I think Cecilia summarized it well. The impact industry is growing up, it's evolving, and those of you who are parents know well that as your child is growing up and becoming responsible adults, the teenage years are really important, right? They can either go off track or they can become real responsible adults. And I think the value of larger funds and private equity is to sustain that authenticity and responsibility from the early stages of venture capital all the way to when they become public or become a larger scale platform. And we all know this is a private capital event, that private companies are staying private for longer. They are really mission-driven entrepreneurs and management teams out there that want to maintain that ethos as they scale. And it's really important for larger private equity firms to recognize that and to maintain that ethos through not just through the sourcing, but also through their hold periods and through their exits. So I think that authenticity is a really important piece in this part of the ecosystem.
And just a follow-up question to that is, how do you think about scaling to match the size of these problems, right? The UN Sustainable Development Goals, they say you need 5 trillion to 7 trillion of capital invested over the next decade to get there. And like we're saying in impact, there's 502 billion today. That's a big delta. How do you think about really solving these problems with this kind of capital?
I mean, there are all different kinds of equity capital and debt capital, right? There is the larger scale infrastructure capital that can be deployed for larger scale projects. There's all the debt that can go along to finance those projects at different risk return profiles. And then on the corporate equity side, I would say as the industry is developing, as these mission-driven entrepreneurs are scaling up their platforms, there are more opportunities to find those opportunities at scale. Of course, I think in any industry, it's really important to not overcapitalize these businesses or overpay, because I think that drags down returns for the entire field. But you can do it responsibly, and I think you can do it at scale.
Well, Christian, I'm so excited that you're on this panel because you have sort of a different take on this space, and you are thinking at very big scale. So I'd love to hear what you're doing at Impactive. Sorry.
Sure. So our approach is a little bit different. So we are a public markets investor. We take concentrated stakes in publicly traded companies, and we work with those companies to improve their ESG profile over time. What I think is interesting about the way we do it, which is different than many others, is we're focused on those areas in which you can both improve the ESG profile of a business, but also drive real shareholder returns. So if I did answer the poll question, which I didn't, I would definitely have picked the one that says ESG drives returns, because it's literally the foundation of my business, as opposed to what is ESG, which would not have been a great answer. We work with companies really across the board, but particularly in the sort of small and mid-cap space, where you have a bunch of businesses which some have management teams that really care about impact and ESG, some don't, but they all care ultimately about driving returns. And our forte is going to those management teams and boards and explaining to them what I think most people in this room sort of know intuitively, which is in the future, having a sort of forward-thinking ESG strategy for corporates is going to be very important for driving long-term returns. You see sort of millennials, I think, were mentioned in the last panel too, as sort of also being people, but there are a large group of customers who really make a lot of their investment, their dollar consumer purchase decisions on the basis of how a company's perceived from an ESG framework. And so working with these companies is really a big part of what we do. Maybe to give an example, we are a large investor in Wyndham Hotels, which is the largest hotel franchisor in the world. And if you've ever studied the hotel business, you know that they are massive sort of wasters of energy, massive polluters, consumers of water and producers of wastewater. And we're working with that business to do what you've often seen in higher-end hotels, which is where if you sort of check the box, you can not have your room cleaned, but to tie it ultimately to their loyalty program in a way that is both going to add returns to the ultimate corporate and result in many, many more hotel guests choosing not to have the room cleaned an extra time, which results in reduced water waste and reduced energy consumption, along with a series of other environmental projects that we're working with them on. But from our perspective, we think the best way to scale real impact investing is to go to these sort of large corporates who are having already the biggest sort of environmental footprint on the world and getting them to make changes that both make economic sense and also improve ESG in the long run.
Yeah, we'll follow up on that question because you sort of said make these changes for the future.
Yeah.
Right. So when is the future in this space? I guess you look at the Climate Action 100, right? This group of investors that say they're going to try and press the biggest polluters to change. And just this week they said that only 9% of companies are aligned with a 2-degree scenario for global warming, right? So a lot of those big polluters have to get there. So when's the future?
I think there are two ways to look at that question. One is you're absolutely right, the challenge is enormous. But from our perspective, it also means the opportunity set is enormous, which is there's tons of low-hanging fruit from all these companies that could both do the right thing from an environmental perspective, but also generate meaningful returns for shareholders in excess of what they would otherwise do. And some of those could do that sort of right now. So the specific example I gave you was sort of, it is in pilot right now. It's a much bigger lift to go to some company whose entire business is extracting hydrocarbons out of the ground and tell them what you need to do is extract fewer hydrocarbons out of the ground. But to your point, we're 2% of the way there. There's a lot of overlap between sort of doing the right thing from an ESG perspective and also driving real shareholder returns.
Cecilia, I see you nodding. How do you think about that and when the future is at Bain?
Well, I think if you think about it I think meta, it becomes overwhelming. And so we think about it as let's have annual targets, let's have targets through our investment thesis. So let's just make sure that we can absolutely deliver on a size and scope that we think is actually real impact, and then make sure we're tracking and driving those improvements. And so in some sense, we absolutely believe in the vision, but also not to have it be so meta that we can't actually track measurable results on driving impact.
Right. So, well, you guys are all investors, so we're talking about saving the world, right? But also you want to make money. So, Casey, maybe you can talk to us a little bit. What are returns like in this space?
It's funny when you talk about returns, and you were mentioning you do conferences in London. When they ask this question internationally, first off, it's never asked because fiduciary investors believe, particularly in Europe, Australia, and Canada, that part of your fiduciary duties are to consider these mega trends that are occurring in the world. And just tying it back to your last question about when is the future, I mean, to me, it's now. I was at a global macro conference this morning that had nothing to do with ESG. Probably 80% of the people would have responded, what's ESG to the conference, at the conference. There was a central bank governor speaking from an emerging country. His first question to him was, what are the 3 mega trends that you think about? And he said, automation and technology, demographics, and climate change. I mean, this is what people are thinking about. And this idea that firms that are positioned to help mitigate or adapt to climate change is one specific area where we think both in public and private markets you can see long-term outperformance. And so, I guess my question to that is twofold. One is, if ESG is integrated thoughtfully, we've all done a disservice to ourselves, I think, by pretending like all you have to do is consider ESG factors to earn excess returns. I don't think any of us actually think that. I think you need to thoughtfully think about and blend ESG with traditional financial analysis. I think if you do that, it should provide an edge long term. And if you're thinking about positioning investments alongside some of these mega trends, this return question kind of just fizzles off in the distance.
Liqian, I want to ask you the same question about returns and how your clients are thinking about it at Cambridge.
Yeah, we actually track performance, just to take clean energy as an example. We track and actually publish returns on a quarterly basis on our website. And actually, this is also in the report that we published just a month ago. We track 1,500 deals from the year 2000 in our clean energy database, backed by over 700 different private equity and venture capital funds. And it is true, in the mid-2000s, during the clean tech 1.0 wave, we saw 7 straight years of flat to negative returns. What happened? Because you had a lot of overcapitalization of companies in very capital-intensive businesses. And what's changed since 2012 and 2013 is that, to your point earlier, Casey, I think the industry and the entrepreneurs have learned a lot of lessons. They're applying more smart approaches and strategies to their investing. And since 2013, those numbers are more in the 20% gross IRR range. And that compares really well to our broader venture capital private equity benchmark on a relative basis as well. So the numbers are actually coming through. It's not just a aspiration that you can generate these types of returns in private markets. Those are recent year returns that we are tracking in real time.
Yeah, maybe Christian, I'll throw that question to you too about public markets, because there was actually a big moment for impact investing this year when Beyond Meat went public, and it was like the best performing IPO in almost a decade. And that started as an impact investment for a lot of investors. They made a lot of money.
Yeah, I think to Casey's point, the impact historically over a long period of time, the public markets, there have been not great returns from purely inclusion or exclusion-based public market funds. And I think you really do need to marry traditional metrics with impact investing in order to get the best bang for your buck. Clearly, there are areas in which investing, specific companies making investments in impact can really drive sort of good long-term returns, but that has to be within the context of an overall high-quality business model with real barriers to entry and real returns on invested capital over time. And so from our perspective, you really do need both. You can't just basically throw money at anything that calls itself impact and hope for long-term good returns on that basis. I think that's sort of been something that has plagued a lot of the sort of purely formulaic-driven public market impact investments in the past.
If I could add, one thing to that, I think the major asset owners, particularly I'm thinking about European institutional asset owners, are just dying to hear this type of pragmatic approach. I mean, one thing that we think about in the public markets is ESG industry relevance, and it's just acknowledging that ESG issues matter more in some industries and less in others. And there are some industries where ESG issues don't play the predominant role in driving the risk and return profile, and therefore you would weight investment factors a little higher than that. And when you speak about things like that, about integrating this in a sophisticated way so that you're not just ESG all the time, that's the kind of pragmatic approach that people are really hoping to hear.
All right, well, we have another poll question. Let's try that for the audience and think about basically where you can make returns. Everybody ready for the polling? So where do you see ESG and impact investing having the biggest benefits? And the poll question answers are coming up here. Aging infrastructure, affordable housing, energy transition, healthcare, disease, emerging markets. Really curious what people say. Energy transition, wow. Maybe Cecilia, tell us where you guys are seeing the biggest impact, and we'll start there.
So we're domestically focused for impact fund, and so I'd say healthcare investments have been a really large area of focus for us. I think surprisingly, even with ACA and Medicaid expansion, we still have millions of population who don't have access to affordable health care. So we're very much focused on providing affordable, quality health care for a vulnerable population. I think this is really prime for impact investing because, especially the vulnerable population, we have an investment both with Rodeo Dental, which is pediatric dental care, largely targeting the low-income and Medicaid population. We have a Phoenix Care System, which is really servicing the IDD population, which is intellectually or developmentally disabled. And so these are folks who cannot self-advocate for themselves. And so we believe a stakeholder approach to this where we have, we really can help advocate and lobby for their interests. And so I think both based on the absolute need of people having access to affordable quality health care and based on our impact investments' ability to really advocate for some of their needs, I think really makes it a high impact area for us.
Great. Yeah, I think the poll results are really interesting because the audience sees energy transition, so maybe that just shows the success of energy transition and how much solar and wind have benefited from impact investment. But that's not the only impact investment. I feel like actually affordable housing is sort of at the bottom, but that's like one of the longest success stories in the impact space. So Casey, yeah, can you respond to this and think, is this where the biggest benefits are going forward?
Yeah, I would just say 2 comments about energy, and then I'll tie that in affordable housing. I mean, I completely agree with the energy transition, but I think there's more sectors than renewables. We keep tying ourselves down to that. I mean, in the public space, we think of water infrastructure and technology, climate support systems, waste management systems, pollution control, energy efficiency, food, agriculture, and forestry. I mean, these are real sectors that are developing within both public and private markets. And when you think, I mean, it just, to me, it's not hard to think about the city of New York, the city of Boston, and the city of Miami have hired climate solution consultants that are publicly traded firms to walk those cities through the mitigation and adaptation things that they're going to need to do in the future. And they're going to have to deploy capital expenditures in order to do that. So I think that's the climate solutions is one of the most obvious ones, and you'll see it through increasing regulations and increasing capital expenditures. And then to your point about affordable housing, I'm just thinking about juxtaposing being in Europe versus the US. You have a lot of large asset owners in the US who are large foundations who want to earn a return, want to generate impact, who have community-based emissions, and they are ultra focused on affordable housing and also very much believe that that's an area where you can both catalyze change but generate returns.
Yeah, that's right. We've seen a lot of this rise of place-based investing in this space in the past year. And so Liqian, you're like an expert on climate adaptation. I love hearing you talk about that space. So where's the investment going for that? Where are our seawalls?
Well, first of all, I absolutely agree with Casey's comments in that this is a large market and you have to take a thesis-driven approach when you're building a portfolio. So I sit on the allocator side, and we help our clients think about, okay, what are the markets that are going to be fundamentally disruptive and attractive going forward? And of course, it's not just one area. You have to build a diversified portfolio, and you can build a portfolio with infrastructure assets, real assets, growth equity, venture capital, and buyout assets. And where those particular assets play depend on what's actionable today and what are really the sources of value creation over the next few years. You mentioned adaptation, really important point, because even though most of the attention, in my view, and observation over the last few years has been on mitigation, how do we reduce carbon emissions, the effects of climate change are happening now, right? We are seeing the effects of more frequent and more intensive extreme weather events affect our communities. They're affecting infrastructure. They're affecting physical supply chains of our businesses, and it will continue to do so over the coming years. And I think the adaptation piece is really important in terms of providing support and reinforcement for that resilience, both at the infrastructure level, at the municipality level, and at the community underlying businesses level.
And what's the pipeline for that look like? Are there enough opportunities to deploy capital there?
So a lot of those businesses are not defining as climate adaptation strategies or businesses. They are analytics businesses to understand risk or insurance premia or understand the potential destruction of a physical asset. There are businesses that are really trying to provide infrastructure support and services because we will need more of that going forward. So they might not come across and say we are a climate adaptation business, but there are many businesses and companies that will fit into that strategy, and I think there will be more over the coming years.
Yeah, it seems like climate risk really affects every sector, and I'm curious how you guys approach that at Double Impact, Cecilia.
Yeah, I think we try to think about it broadly, both from, there's the consumer trend, which is, consumers and the millennials we talked about earlier becoming much more conscious in their everyday decision making. So both from a product side, but also from our company's supply chain as well, trying to really impact energy usage, water, savings, gallons of water saved. And so I think we try to think of it as, holistically, as I think Liqian mentioned, not many businesses are specifically focused on climate adaptation, but that many businesses obviously impact climate effects. And so we try to think holistically about every business, no matter what sector.
Yeah, one thing that I think is a really hallmark of this space is the long-term thinking and trying to put value on different long-term problems. So, Christian, how do you guys think about that at Impactive?
Well, within the public markets, we have a very long-term time horizon. Certainly not quite private equity levels, but our capital is a 6-year locked capital, which for a public market investor is an extraordinarily long period of time. And I think it's because when you're making these impact investments with corporates, it's especially important to be able to communicate to those management teams and boards that you're in it for the long term, that these investments that you're making are ones that you think really are going to pay off over the long run. And so that's really the lens in which we are looking at really all the decisions that we're making and all the advice that we're giving to all these companies. And we do that across, there's been obviously a lot of focus in terms of climate. We look at both the risk factors to the specific businesses that might be affected by climate change, but also how we can have those businesses have less of an impact in terms of the overall climate. But we look at it across all three of the ESG factors, and one that hasn't really come up, but that we really look at a lot is sort of the S of that, the diversity and inclusion factor, which to give a very sort of a high level right now in what is a very strong economic environment where there is a war for talent in terms of sort of labor relations generally, we see a lot of opportunities for the companies in our portfolio to expand their access to labor pools by targeting non-traditional elements of the labor force that we think are going to help it grow even faster. And so those are long-term trends, and those are things that we talk to companies about that likely won't pay off until year 2 or year 3 or year 4. And that's why it's very important to have that long-term focus when it comes to impact investing.
Liqian, how are you guys at Cambridge valuing sort of ESG and impact as part of a whole portfolio and seeing that? I guess I hear sometimes a big investor will say, hey, this is a diversification opportunity for me. I'm exposed to a lot of risk and I can use impact that way. How are you seeing people value it?
Yeah, I think, again, it goes back to risk management on the ESG integration side, which we are now doing across our entire research platform, across different asset classes. And then in terms of that thesis-driven approach, it's really about targeting specific opportunities on the private market portfolio. A lot of that is venture and growth today because historically that's where most of the activity is, that's where a lot of the offerings are, but we are starting to see more on the buyout side as well. So building, again, a well-designed portfolio. And we actually have a slide on best practices in impact investing. And do you back talented teams? Do you think about appropriate diversification? Do you think about avoiding the herd and being value conscious? I mean, those are all best practices that apply to traditional investing as well. So the point is that there really shouldn't be any difference in portfolio construction and fundamental research. You don't check those things at the door when you enter the arena of ESG and impact. It only enhances your work as an investor over the long term.
Okay, so we have our final lightning round question. Everybody gets 1 minute to talk about this. So what area of impact investing and ESG do you think represents the best opportunity and the best returns from both a social and economic and environmental perspective? Casey, go.
I don't want to repeat myself, but I just think it really is climate solutions. Climate change, in that there's also a social element to that. I mean, climate change is impacting particularly underserved populations the most. I mean, climate change is happening now. People are spending money to mitigate and adapt to climate change. There's the sectors that I mentioned, from water to waste to pollution control to renewable energy. There's also one thing that I didn't mention, which is customer loyalty. You have companies like big e-commerce companies, I won't name a name, but we probably all bought packages from them in the last week. They are very much focused on customer loyalty, and they think that by not being the most environmentally friendly, and they think that having worker rights and human rights issues is eroding customer confidence, is a very serious risk to their business. So this is something that everyone's thinking about.
Weird thing to say at the private capital conference, but from our perspective, we think the best opportunity lies both in terms of the impact that you can make and the returns that you can generate, going to the large swath of public corporates that exist and getting them to make relatively easy, low-hanging fruit changes that can make a pretty big impact on the environment and also drive meaningful returns for investors.
I'm going to agree with Casey, but give a different answer. I do agree with Casey that climate change is a significant opportunity. We invest across, so many solutions to address that. However, for us, it's not a specific vertical because it's across, different parts of the organizations. So I'll go back to healthcare in that, with the rising cost of healthcare, I think that there's lots of opportunity to drive, attractive returns. And because healthcare is so broad, from provider services to med tech to all these different subsectors, it's a very large area, and we found, very attractive returns in the healthcare sector.
For us, I think about it in terms of industry tailwinds, and you want areas where not just one tailwind is in your favor, but multiple at once. So I take the example of grid integration technologies, right? You know that wind and solar costs are declining. That's a tailwind for the renewables industry. You know that EVs are getting better and cheaper. That's a tailwind for the electric transportation industry. And then you know that software is getting cheaper in terms of compute power, in terms of efficiency, and also cloud storage. So those are all mega changes in the industry. And what you have is now you need solutions to integrate all of those to provide the grid and utilities better management of the load. That's just one example. But we like areas where those different tailwinds intersect to create a really actionable and compelling opportunity.
Well, this is such a wonderful panel. I mean, just to hear about all these megatrends and how you think about processing them and integrating them and seeing how they'll affect the risks and opportunities going forward was a great experience. So thank you, everybody, for joining us.